more people to join in, let me share with you our unit trust transferring promotion. From now until June 30th, 2026, receive 20 Singapore dollar capped at a maximum of 200 Singapore dollars for every 10,000 worth of unit trust holdings that you transfer in. Your unit trust holdings must be held with UOB Kay Hian for at least 3 calendar months from the effective date of transfer to qualify for the promotion. To find out more, please scan the QR code. Details of this promotion can also be found on our website, utrade.com.sg. We are also now on Telegram. Do remember to join our channel, UOBKH Trading Ideas, for the latest market insights and promotion, simply by scanning the QR code. This evening, we will be hearing from John. There will be a short Q&A session after the presentation. Feel free to send us your questions via the chat box. We would also appreciate if you could take a few minutes of your time to complete the survey form that will pop up after the session ends. Without further ado, I will hand the time over to John. Thank you.
Okay. Yeah. Good evening, everyone. Thank you for taking the time to join us today for our presentation on S-REIT first Q20 first 1Q26 results update. Okay. So it is our observation that since last quarter, that's 4Q25, and continuing into this quarter 1Q26, we have been observing that more S-REIT are reporting better results, and more S-REIT are beating expectation. And then I think what we also observe is that there is a gradual upturn in the performance for many of the S-REIT. So for this first Q26 quarterly results, 4 S-REIT outperform forecasts. They are Fraser Centrepoint, Fraser Logistic, Keppel DC REIT, and also Suntec REIT. Unfortunately, 2 of them sort of misestimate, and in some cases for good reasons. But they are Keppel REIT and Mapletree Pan Asia. So there are outside of this list, there are about 11 large cap S-REIT that met expectation. So this is a sector that has gone through more downs than up in recent years. Okay, last year we have a short rally of 11%. So far this year, because of the Iran war, the sector is down about 7% for the first 5 months. Nevertheless, valuation is attractive. In terms of yield spread, we are about close to 1 standard deviation above the long-term mean. The long-term average is about 3.2% in terms of yield spread. So current yield spread of 3.8 is actually quite attractive. So we have 4 sort of top picks for the sector. These are difficult times with war in the Middle East. So our top pick is CICT. We being the biggest and being very diversified, it can help us ride through the ups and downs in the economic cycle. We also observe very good execution at Fraser Logistic. Over the last 2 quarters, occupancy has improved. NTTDC and UI Bausted, they are new IPOs. In the case of NTTDC, the yield is 8%. In the case of UI Bausted, the yield is 9%. So they just sort of the IPO was quite recent, and maybe not many people are aware of their strong fundamentals, and therefore it may be a good time to buy into NTTDC and UI Bausted REIT. The macro environment in terms of interest rate remains very benign. Interest rate has been low, continuing to be low. I like to highlight like recent divergence since beginning of this year. 10-year government bond yield in Singapore has moved about sideways. Recently, because of the situation in the Middle East, higher gasoline prices in the US, the yield for US government bond actually increased. So it is a bit divergent. People are putting more faith into Singapore. Singapore is now like a recognized safe haven. Government is very frugal, budget is balanced, and we have a clean suite of AAA rating. And the rating agency are not just ranking us as AAA. They are also saying that this rating outlook is very stable. They are not going to change that ratings anytime soon. And of course, in the US, the budget deficit is 6% of GDP, and the debt to GDP ratio is right now is 124%. And in another 5 years' time, it is projected to be about 142%. So more and more people are recognizing that Singapore is safe, and more people are recognizing that US current fiscal situation is unsustainable. So that spread has widened. Just end of last year was the gap between the 10-year government bond yield was 1.92. As of end of May is 2.41. So just within the last 5 months, that gap has expanded by 60 basis point. But in Singapore, because of the liquidity that's flooding into Singapore, bond yield is stable, interest rate is low. So in that sense, it's a good environment for REITs, not all REITs, but REITs that invest in Singapore and borrow in Sing dollar. They will benefit from the low interest rate in Singapore. This chart on the left once again shows how much interest rate has dropped in Singapore. You may notice that in UK they already have sort of a few hike in interest rate. Japan, of course, the economic cycle is different. They have small increases. But what we want to highlight here is in Singapore, how much interest rate has dropped from almost about 3.9, almost 4%, dropping to about close to 1% over the last 3 years. So with even this year continue to drop about 13 basis point to 1.06 in the first 5 months. And REITs are benefiting because they can issue bonds at a very low interest rate. To give an example, CICT issued 300 million, 5 years, and interest rate was just about 2.2%. They done that about 2 months ago. So that low interest rate environment continued to be a positive catalyst for the sector. Of course, we are living in uncertain times, and the situation in Middle East it seems to drag on, and ECB has signaled that if the Strait of Hormuz remain closed, then potentially they might hike interest rate come June. In the US, it's a bit difficult to forecast because they have a new Fed governor with a new way of looking at inflation. So on the US front, it is uncertain, and we just have to maybe be patient for them to wait for them to make the next decision. But in Europe, uh, if the current situation is maintained, then they will be hiking in June. I will run through sort of we break down the sector into actually 7 segments. So I'll be running through like the results for retail, office, diversified commercial companies with exposure to both office and retail, logistic, data center, and also diversified industrial, the companies that have exposure to various industrial segments. We have here 6 segments. We skip hospitality because hospitality is affected by the strong Sing dollar. So to kick off with retail, what we notice is that as a trend, many retail companies are reporting higher growth in tenant sales. The tenants are doing better, and that support higher rental in future when they negotiate regarding new leases. So Fraser Centrepoint result was above expectation. They have positive rental reversion of 6%. Occupancy remains very high. People been worried about impact of RTS and Singaporeans shopping in JB, but to date, the performance of their malls located near the causeway or in the north has been quite stable. An example would be North Point City. They own the north wing, recently acquired the south wing, but together both north and south wing together, occupancy is almost 100%. There's no sign of weakness. The NPI, the net property income contribution, is 49.5, accounting for 31% of group NPI. So looking at North Point, how it performed, certainly no sign of weakness for malls that are located near Johor. Causeway Point recently backfilled the vacant space vacated by Cathay. They were able to backfill, and net property income also increased by close to 2%. So they will look at transforming Causeway Point into a regional mall, but I think they are waiting for RTS to be completed and running and see how the new dynamics work before they confirm their plan and then do a significant AEI to improve Causeway Point. Land lease is similarly doing better. Their rental reversion for 3Q is 12%, higher than 10% in the first half. Tenant sales again is stronger, 2.5% growth compared to 1% in the first half. They have in the past, people were sort of unhappy with their big exposure to perpetual securities. They continue to downsize that because the perpetual securities expiring is 200 million, but they only refinance about 120. And as they reduce exposure to perpetual securities, the interest coverage ratio is improving. So calendar year, this year 2026, towards end of the year, there is two major milestones. The AEI that they are planning for PLQ Mall will be completed. It's about 16,000 square feet of space that they will reconfigure for F&B, for fashion retailer. So these are smaller tenants that will be paying higher rent. So they complete AEI end of this year and then get higher contribution next year in 2027. The music hall at Grange Road car park right next to 313 at Somerset, that will also be completed by end of this year. So that will improve traffic at 313 at Somerset. And again, it will be good for their outlook in 2027. Okay, so land lease also showing stronger performance for the retail segment. For office, the supply remains tight, and for the CBD area, demand is very strong, but supply is very very little. So rents continue to creep up at a gradual pace. For Keppel REIT, one of the stock that underperform, income from JV is grow quite significantly, and also average cost of debt drop. They acquired a shopping center in Sydney, and that has contributed about 10% of their total NPI. As you know, they acquired Marina Bay Financial Centre Tower 3, that dilutes DPU by 6%. So that continues to be a drag for their performance in 2026. They completed the acquisition of MBFC Tower 3 in December last year. So that dilution of 6% will materialize in 2026. Right now, the gearing is a little bit elevated, so they will have to focus on divestment before they acquire again. Okay. Suntec is conversely, Suntec is doing better. The DPU grew by 24%. The growth is mainly from the JV. JV would be Marina Bay Financial Center and One Raffles Quay. That grew by 9%. They also benefit from lower cost of debt. Between office and retail, their retail is doing better because Suntec City Mall achieved rental reversion of 19, kept occupancy high at 99, and they expect that retail will continue to provide positive rental reversion of 10%. As you know, Hong Kong Land has taken up a 10% stake in Suntec. The way we read it is that, firstly, Hong Kong Land has shown a very keen interest to invest in Singapore. They have set up a private real estate fund. They have taken up a 10% stake in Suntec REIT. And lately, of course, there's news that they are bidding for Marina One. Marina One is the big office complex at Marina Bay, owned by a JV between Temasek and Khazanah. So that's a huge office project, and it is in the early stage of negotiation, but it is industry players mentioned that Hong Kong Land is also bidding for that. So it does appear that they are very serious and very keen on expansion in Singapore. The more they expand in Singapore, the more that they may need sort of a REIT vehicle for their Singapore business. So, but we believe that Hong Kong Land is patient, so it may be a long drawn affair before they up their stake again. But certainly, we feel that something is brewing, and in time to come, Hong Kong Land may increase their shareholding in Suntec REIT. That's our expectation. Okay. Diversified commercial companies that actively invest in both office and retail tend to be, larger, REIT. Okay. So CICT, the results was in line, but we are happy about the NPI growing about 8%. They have very strong funding franchise, and their cost of borrowing is down about 50 basis point to 2.9. So their average interest rate is now below 3%. Their retail segment has been very stable, with stable occupancy, tenant sales growth at 2%, which is higher than previously. Office, they have a big jump of 30% because they acquired the remaining 55% of Capital Spring. And they done that last year. So now this year, Capital Spring at Raffles Place is now accounted as a subsidiary instead of a JV. So that accounted for that huge jump in income contribution from the office segment. They are actively rejuvenating their portfolio. So for Capital Tower, they are building a 2-story pavilion that will house F&B. There will F&B space. And in Singapore, it is difficult to acquire another mall. So they are flexible and innovative. They have instead bought land in Hougang to develop a mall of about 300,000 square feet in Hougang. So that speaks a lot about flexibility and innovation, difficult to acquire from the market. So they instead choose to buy land to build themselves. So I think that says a lot about their, not just their, recently they made sizable acquisition buying Iron Orchard, followed by Capital Spring, followed by recently, of course, they buy Paragon. Paragon is unique because it is freehold, and now they are also buying land to build, develop new mall so that they can continue to grow. Yeah. Mapletree Pan Asia, we mentioned earlier that it was below expectation. So this $8 million charge is one off and was unexpected, and it arises from their divestment of the office component of Festival Walk in Hong Kong. So this was a bit unexpected, but in Singapore they continue to do well. Vivo City is always the star performer. Income increased by 6%. Rental reversion is 14. Occupancy almost full. Amazingly, management can squeeze good performance from Vivo City year after year. Mapletree Business City, there was some vacancy, but they have managed to secure a new IT tenant. So now MBC is now occupancy is 96. They are continuing to engage potential tenant, and hopefully this number move even higher in the quarters to come. Singapore is now 66% of the group's net property income. Yeah, there was some positive news coming out from Festival Walk in Hong Kong. Tenant sales up 6%, driven by luxury sales. But this is kind of like the first quarter of turnaround. Management do not want to sort of overpromise. We continue to monitor that closely. Hopefully that trend continues, and then there could be some turnaround in Hong Kong as well. They are planning to do some upgrading in Hong Kong to convert 18,000 square feet of space into a F&B and lifestyle cluster. So some enhancement work finally that they are doing at Festival Walk in Hong Kong. Okay. Of course, CICT, the yield is now about like 5.2%. Mapletree Pan Asia is higher, I think about 6.5%. So there is Mapletree Pan Asia yield is at 6.5 is attractive for a company of this size. Very few large cap blue chip REIT trade at 6.5, which makes them actually a ideal candidate for CICT to acquire. So if the rumor about CapitaLand merging with Mapletree is eventually, if it eventually materializes, then CICT would make a bid to buy Mapletree Pan Asia. So there is some latent hidden potential within Mapletree Pan Asia. For the logistics segment, our views are unchanged. We continue to like Fraser Logistics, and they have in terms of share price outperformed MLT. So just looking at the occupancy number, you can see that Fraser Logistics the last couple of quarters executed very well with occupancy on an uptrend. Ascenders not the case. MLT stable. You know, they for kind of it's a compromise. They live with lower rental reversion to make sure that occupancy remains high. In terms of outlook, we continue to like Fraser Logistics because the logistic properties, whether be it in Australia, Europe, or UK, maintain full occupancy. Is full occupancy like almost consistently every quarter, and overall, including the properties that they have in Singapore, they're able to generate positive rental reversion of 23%. In the past, they have some hiccup, particularly Google terminated a big lease of about 200,000 square feet at Alexandra Technopark. They have since backfilled 83% although the new leases, majority of them will commence in January next year. So they have signed the leases, just that the commencement will take some time, and then the cash flow kicking in sometime later, about 6 months later. The DPU is flat, but that is remarkable because in the past, what they dish out in terms of divestment gain is huge. They are keeping the divestment gain so that they can reinvest in new acquisition. So because giving out divestment gain can boost DPU, on a short-term basis, but but a more meaningful way would be to reinvest so that the additional contribution from acquisition is higher and recurring. So they have moved away from trying to boost DPU on a short-term basis and preserving their balance sheet and keeping a lower gearing so that they can use that for acquisition, which can boost DPU on a long-term basis. For MLT, China is a drag, although that drag is now moderated to about 2%. So China remains a challenge. Okay, they have a big part of their China portfolio is in Eastern China, and this market has a very high vacancy of 25%. Eastern China refers to the area around Shanghai, Zhejiang province, Jiangsu province, around those areas. And in China, tenants are also renewing on a short-term basis, like 1-year leases. So there is always a churn. There's always a need to renew leases every year, and that also shows that tenants are still feeling that the market is weak, and therefore they sign short leases so that they can benefit from further drop in rents. So in China, I think the challenges remains. Yeah. Outside of China, rental reversion has also softened, and that's why overall rental reversion is 4% compared to in the past. It could be 6% or higher. For data center, we think that the outlook continue to be positive. The demand obviously is very strong, and a lot of new data center being built, but there is a lot of delay for new construction, and therefore the existing data center owned by the REIT, the demand would continue to be strong. In our previous sector report, we mentioned that Keppel DC REIT and NTT DC, we view that as sort of a core holding for data center. For Keppel DC REIT, the result was above expectation. Net property income grew by 19%. The boost came from Tokyo Data Center 3. And portfolio, of course, occupancy is stable. They clocked a very huge number, positive rental reversion of 51%, but that's for a very small lease in Singapore. It's not reflective of the general trend. So in subsequent quarter, the positive rental reversion would be positive, but not as high as 51%. Okay. In the past, they have generated very strong DPU accretion when they buy data center from their sponsor, Keppel Limited. So like SGP7 and SGP8 was the previous acquisition. Unfortunately, SGP9 is still under construction. So near term, if they have acquisition, most likely buying from third party, The next acquisition from the sponsor likely to be SGP9. That maybe happen sometime later, maybe in like 2028. So we like the company, we like the sponsor. Uh, the big boost will come only sometime later. For NTT DC REIT, positive rental reversion 13%, higher than previously. Okay, they have done well to secure the backfill vacant space. Based on the leases were signed last quarter, which is 3Q FY26, but the commencement of the leases will only be in 1Q FY27. This is the June quarter. So for the June quarter, occupancy will increase 3 percentage point to 98, purely because the new leases that they previously already have signed will commence quite soon. In their latest result, they also reported 11% increase in their portfolio valuation, coming from data center in North Virginia, that's up 25%. The data center in Singapore is valuation is up 20%. So that helped to increase their NAV by 20% to 114. Okay, so the NAV has actually increased a lot to justify a higher share price. I think share price has recovered, but not sufficient to reflect that 20% increase in NAV. Okay, we continue to view the stock as undervalued because yield is 8% vis-a-vis like 5% for Capital DC REIT. So I think market is not giving the due recognition to NTT DC REIT as a landlord for data center. The last segment is diversified industrial. So we have the traditional leader, Ascendus, compared to new kid on the block, UI bolstered REIT. So in the case of Ascendus, rental reversion has continued to be quite strong, 12%. But while we saw some slippage in terms of occupancy, like for Singapore is down 0.6 percentage point. Australia down about 1.4 percentage point to 93. They have a lease expiry in Melbourne. So rental reversion is strong, but occupancy is showing some sign of weakness. They have made a lot of acquisition recently. We like particularly 25 Loyang Crescent. It's a huge plot of land with only half the plot ratio utilized. So if they redevelop, they can add about 1.6 million square feet of logistics space. So that acquisition, in my view, was quite a good deal, and also comes with a very good tenant in terms of an offshore company by the name of Toh, Aussie company Toh. Okay, UI Balser REIT just got listed. They for in March, so I mean their year end is in March. So if they were to stick strictly to the March financial year end, the last financial year they only have like 20 days. So they will lump that 20 days into their together with their lump it together with the FY 27. Yeah. So but what they promise in the prospectus, they are executing according to plan. So they have promised certain, they have guided certain improvement in terms of occupancy. So at 26 Tai Seng, the lease with KFC has been signed. So 26 Tai Seng has a central kitchen. So that helped them to attract a lot of F&B tenant. So KFC helped generate that 15% improvement. So 26 Tai Seng is now 96% occupied. The office building in Tokyo, the lease with the Japanese insurance company has been signed already, so it's now fully occupied. In Greater Osaka, Konan Phase 2, occupancy is now about 83. Okay, but they have about another 12% of space in advanced negotiation. So if this 12% is successfully closed and signed, then occupancy for the property will go to about 96. So in general, we are seeing them executing based on what they have promised during the IPO. Post the IPO, they have also taken up a 51% stake in JV with their sponsor, which is Bousted, for a build-to-suit integrated facility for their top tenant, Bombardier. Bombardier is one of the largest maker of private jets in the world, and this business has to be conducted at Seletar Aerospace Park because private jets can only land at Seletar. So this will be their fourth facility for Bombardier. It will increase their exposure to aerospace and automotive by 3 percentage point to 22%. So comparing the two, yield for Bousted REIT, UI Bousted REIT is 9%. I think it's very unfortunate for the company because they got listed after the Iran war has started. So it's very unfortunate timing, and it caused the stock to fall below IPO price. But the fall in terms of magnitude is the same as Ascenders or other industrial REIT. But the unfortunate timing result in share price dropping and yield being high at 9%. So I think as they execute their plan, as they deliver good DPU, that 9% yield should compress to a lower level towards like 7 should be logically it should head towards 7% because there are smaller company in the same space that are trading at tighter yield. Okay, so with that we have run through most of the key segments, and then we can move on to Q&A. Okay, let me toggle to the Q&A screen to look for your question. So I have a question on UI Bousted REIT. So BOJ is expected to hike rates in the near future. How would it affect UI Bousted REIT? Thanks. So they will not sort of feel the full impact, in the sense that about 45% of their loans are denominated in Japanese yen, and if I read correctly, the interbank interest rate in Japan was about 80 basis point end of last year, and then as we currently the last time that I checked, it is about it is close to one. It was 125. So we done a rough calculation. They hedge like 50% of their interest rate. So for that 45% exposure to yen loan, about half is hedged, and then half we assume is floating. Management actually say that for yen they hedge more than 50%, but because they didn't disclose the number, I've conservatively assumed that they hedge just 50% for for Japanese yen. So previously the management guided that cost of debt for the entire company is 2.5%. So assuming that this movement of about 50 basis point, the interbank rate in Japan moving from 0.8% to like 1.3%, we calculated that roughly that increases the cost of borrowing from 2.5 to 2.65. So that is one thing, because they hedge, is yen is like 45% of their loan, and then they hedge half of that, so it's not the full impact. Secondly, I think we also need to recognize that the yield for the asset is like quite high. So like on average, the yield for the Singapore asset is about, let's say, 7%. So when the asset yield is high, the negative impact from changes in interest rate becomes smaller. So there is this two factor that you need to consider. They also borrow in Sing dollars, where interest rate has been sideways, in fact coming down. So yeah, yen is only like 45% of their borrowing. They hedge half of that, so it's not a full impact that we're talking about. And then secondly, because the yield from the pool of asset in Singapore is quite high, so that comparatively speaking, sort of make the impact smaller than another company that has asset with a lower yield. Okay, so there is a negative impact, but it's a very manageable negative impact. We calculated that it reduced DPU by like 1 to 2%. Is a small impact. And also, if you track interest rate in Japan, their move is quite small. Like in the case of like US Fed, every move is 25 bips. For them, they are very so slow, so to speak. Like every move is like 10 bips, very small. When they announce the policy changes, the movement in interest rate is very small. It's a lot smaller than the Fed. Yeah, we're talking about like maybe 10 basis point every time they change policy. So it's the magnitude of movement is not as great. Okay. Okay, so we move on to the next question. I think that there is I saw a question on FCT, so I'm trying to locate it. It disappeared from my view. Yeah, so a question on Mapletree Industrial. So what would be an attractive buy price for Min? Is not currently worth a premium to book value, but perhaps one-time price to book or around 160. So for Mapletree Industrial, I think the problem is that data center is a big part of their portfolio. So like half of their portfolio is data center. Unfortunately, the data center that they have in the States are smaller data center. And so the smaller data center has certain peculiar problem. So they are not, many of these data center, they are not in the traditional hub. So by traditional hub, we mean like Northern Virginia. There's a big cluster of data center there. Silicon Valley, there's a big cluster of data center there. So many of their data center is sort of dispersed around they do have some in the hubs, but majority of what they have is sort of at decentralized location. So one problem with that is that they have a lot of enterprise customer, and it is quite quite easy for some of the enterprise customer when the lease expire to switch to a cloud provider like Amazon or like Microsoft or like Google. So they will tend to get a better deal if they didn't renew the lease and then switch to Google or switch to Microsoft or switch to Amazon. So we have highlighted that in the past that their exposure to hyperscaler is smaller compared to the rest of the REITs. And conversely, their exposure to enterprise customer is higher compared to other REITs. So they are in the portfolio is a weak, their data center portfolio is a weak portfolio. This year, they have quite a fair bit of data center leases being due for renewal. So we highlighted in our report that there are 3 of them: San Diego, Hawthorne, and Alpharetta. The big one is San Diego. Hawthorne, we believe, can be released because they have, for Hawthorne, they managed to secure higher power capacity from the utility provider. So it is there is interest to lease this property. But for San Diego and also Alpharetta, they've indicated that the existing tenant will not renew. We have calculated that if these 2 data center is vacant when the lease expire, occupancy will drop by about 11 percentage point to 75. That will look quite ugly, and therefore we believe they will be quite eager to divest the data center at San Diego. So that would sort of maybe help shore up occupancy, not allowing it to drop so far below like 80%. So based on our current forecast, the yield is about 6%. About 6%. The yield is about 6%. The unfortunate thing is that you can buy NTT DC at 8%. So you compare the two, you have NTT DC executing well. Sponsor has been supportive. In fact, the sponsor even paid for the leasing incentive scheme. So the salespeople, if they find a tenant for NTT DC, the sponsor out of their pocket will give incentive to the salesman. So the sales force is sort of incentivized to refer and secure new tenant for the REIT, and that commission is being paid for by the sponsor. So it shows a lot of support from the sponsor to help improve the operating performance at NTT DC. So right now, Mapletree Industrial trading at 6%. Half the portfolio is in US, and this portfolio is a weak portfolio. Conversely, is good execution at NTT DC, but they are providing you at 8%. So if Mapletree Industrial trade at 8%, the share price has to like fall by maybe like another 10-20% for it to get you the yield here, which is 8%. So I think yes, there is definitely a bottom for this stock, but unfortunately the alternative is so much better. You can buy a better quality stock for 8% yield, and I think our suggestion is that maybe investors should focus a lot more on NTT DC than to maybe waste time and energy on Mapletree Industrial. So there's a question on since US interest rates are expected to go up, how will that impact performance of REITs in general? What is the main driver for S-REIT interest rate costs? So, so firstly, it is not for sure that US interest rate will definitely go up because we have a new Fed chairman. New Fed chairman has talked about maybe a new way of measuring inflation. Whether he succeed in convincing his colleagues at the Fed, hard to say, but we will get some sign of the new situation come the next Fed meeting, and we'll be looking for clues like whether decision is unanimous or there's a lot of debate in the committee. So it is not for sure that US interest rate would go up. Very much depend on the new dynamics once the new chairman is in place. He is already working at the Fed, but he has not sort of chaired the committee as it for the first decision making after he's succeeded the last chairman. So I think we have to wait and see how the new dynamics work. It is not for sure and for certain that interest rate in the US would be going up. A lot also depend on whether there's peace in the Middle East. The latest news is that Israel and Lebanon they sign a peace agreement, and we will have to wait and see whether ceasefire between US and Iran continue, and then whether that peace deal between Israel and Lebanon helps US and Iran to sort of restart the discussion that they previously had. So it is a few there's uncertainty regarding how things will evolve. So on that front, I think it is best to assume that US interest rates sort of move sideways. What is the main driver for S-REIT interest rate? Well, it depends on where their properties are located. So given the current situation, it is more certain that Singapore interest rate will remain low. This is bond yield. Bond yield has been sideways, even though US bond yield has gone up. Singapore interest rate, this is the interbank interest rate, continues to be very low and depressed. So I think that the key takeaway here is that focus on REITs that invest heavily in Singapore with a big portion of their assets in Singapore. That could be like CICT, 95% Singapore. Fraser Centrepoint is 100% Singapore. UI Bausted is about 70% Singapore. So those with big portion of their assets in Singapore, they would have to borrow a lot in Sing dollar, and then interest rate they can benefit from that low interest rate in Singapore. So if recently it does seem that interest rate between Singapore and US is decoupled. So if that is the case, maybe even higher interest rate in US may not create a similar increase. Maybe the increase in US interest rate will be much more than in the increase in interest rate in Singapore. So I think the best bet would be to invest more in REITs that invest heavily in Singapore. Okay, so there's a question on you mentioned that land lease uses less perpetual for funding. Is it good or bad to use perpetual? If bad, why others are using them? So I think there's a good and bad about using perpetuals. Perpetuals, when calculating gearing, perpetuals are excluded. But when calculating interest coverage ratio, the coupons that you pay for the perpetual is included. So when the MAS limit gearing at 50%, it excludes perpetual. So let's say in certain cases, like I think in the case of land lease, when they went into perpetual was when they acquired GEM. So GEM was such a huge asset, and by even after fundraising, issuing new shares, even after getting more loans from the banks, it wasn't sufficient. So they have to sort of stretch themselves by issuing some perpetuals. But it became sort of an overhang because it led to their interest coverage ratio being very low. So I think right now is a healthier situation. So every time they refinance less, they issue like 120 compared to previously the perpetual is 200. So they reduce the reliance on perpetual by about 40% when they refinance only 120 out of the 200. So by doing that, their interest coverage ratio actually improve. So an interest coverage ratio is a important indicator as to the finances of the REIT. So I think there is pros and cons. You can use a little bit of perpetual, but do not use too much of perpetual. If the REIT has too much perpetual securities, is not a good thing, because sometimes sometimes there's good market and there's bad market. What if market is bad when you need to refinance the perpetual? So that then becomes problematic. So a little bit of perpetual is maybe helpful, but too much will be viewed as maybe risky and having the balance sheet overstretched. So these are some of the pros and cons. So when a REIT says it has committed occupancy, does the tenant in a committed occupancy start to pay rent? Uh, so I think when we say committed occupancy, it means that the leases are already signed, and then the tenant already committed, signed the lease, and then they will occupy the space. But sometimes tenants relocate from one place to another, so the time that they can move in is sometimes a few months later. So committed occupancy sometimes can go up, but the tenant may not have moved in yet. The tenant will only start paying after they have moved in. So that committed occupancy may have, let's say, gone up initially, but the tenant may move in, let's say, 2-3 months later, and then start paying rent about 2-3 months later. So committed occupancy means that the space is already taken up, and committed occupancy obviously cannot move beyond 100%. 100% is the max. The actual paying of rent depends when they move in. So there's a subtle difference. So do you think Mapletree Logistics will still drop further due to its weak performance in China, or will it improve? So of course, market is always changing, and I can't help answer the question by sort of pointing you to the currency market, because just 2 hours ago I was flipping the newspaper, and apparently Korean won is kind of dropped to a new low. So some currencies are quite weak because of the Iran war, because of certain countries, they subsidize fuel. So like in the case of Mapletree Logistics, they don't have exposure to Indonesia, but they have small exposure to India. They also have exposure to South Korea. So South Korea is a bigger exposure than India. But I like to answer the question like beyond China. Beyond China, Sing dollar being very strong means that regional currency relatively is weaker. And in the current situation, Korean won could be a headwind. India rupee also is a headwind, but a smaller headwind. So I think besides China, the current situation is such that we need to also worry about some of the emerging market currency. There is a lot of depreciation that is in terms of currency that is caused by the high energy price and the war in the Middle East. Okay, so which REIT has sponsor which allows for further potential scope to grow in Singapore? So I think it's probably a long list, but let me look through and then I'll give you the name maybe one by one. So Parkway Life, healthcare sector, yeah, it is possible. It is potentially possible that they will acquire Mount Elizabeth Novena. So in the case of Parkway Life REIT, yes, sponsor can help them grow in Singapore. For hospitality, definitely yes, because the sponsor in the case of Escort, CDL Hospitality and Far East Hospitality, sponsor have other hotels also in Singapore. Ascendas, Digital Core, Keppel DC. I think their sponsor have data center in Singapore, and it is possible that they grow in Singapore. UI Bousted REIT, yes, I think during the IPO there is a logistic facility in Tuas. Recently, the focus has been on development project. One in Seletar Aerospace Park, and another one in Greater Osaka, Conan Phase 3. But there was properties. There was a logistic property in Tuas that was ready to be injected in UI Bousted REIT. And also the sponsor has recently bought a lot of land in Tuas that large tract of land that could be developed and in future injected into the REIT. Land lease, of course, the potential assets to be injected include PLQ office, and then also Singtelcom Center, which they are redeveloping right now. So Suntec, we mentioned earlier that they could buy 9 Penang Road from sponsor, which is Tang organization. So I think these are some of the example and of REITs where the sponsor can help the REIT grow in Singapore. So I think we are running a bit out of time. So I would maybe choose one last question, and then we have to unfortunately run out of time and end the session. So let me look through. Okay, so last question is on when does the JV between UI Bousted REIT and Bousted Singapore regarding the aerospace facility at Seletar Aerospace Park, when would that start to pay rental to UI Bousted REIT? So it's about 2 years later. So in my calculation, they will start contributing in FY29. So not so soon. It takes about 2 years for them to build. It won't take 3 years because this is industrial facility. It serves as an aircraft hangar. It serves as an administrative office. It serves as a customer lounge. and also there will be MRO services being performed on Bombardier's private jet. So construction takes about 2 years. So 2 years later, you will see this newly redeveloped facility for Bombardier contribute to earnings in FY 29. So let me just see if I can scroll to the PeerCom. So you see that, yeah, that contributing to the increase. So for FY 28, U is 8.8, and then one of the reason why U is higher in FY 29 at 9.2 is the contribution from the new facility for Bombardier. So with that, thank you for your patience and thank you for dialing in. I'll now pass the time over to Rain.
Thank you, John, for this presentation, and thank you everyone for the insightful questions. For more upcoming webinars, please visit utrade.com.sg. We hope to see everyone again soon. Thank you and goodbye.
Thank you very much. Thank you and good night.